Test, 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 test. Hey, Katie. Test, 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 test. I think so. Okay, so hopefully everybody can hear me. My mic is working. I think it's broadcasting through. And we'll go ahead and go through the um, the lender letter. So Fannie Mae releases these lender letters. This lender letter in particular has to do with some of the upcoming changes and some that are immediate changes for the Fannie Mae condo regulations. Now, there are other lenders that do condos, not just Fannie Mae. So the good news is, even if this is something that's changed what you were hoping to do with the condo financing, there's still plenty of options out there. Not everything needs to go Fannie Mae. It's an investment property. DSCR loans are really, really good right now as far as pricing is concerned. So um, we'll go through a few of the high points here. So one of the big things in this announcement before we get to the investor concentration limits is um, Fannie Mae has currently two categories of review that are required. If you do a very low down payment, then there is something that's called a full review that's required on the condominium. And the full review process um, encompasses a lot of different things, but one of the main reasons why we don't like doing full reviews, especially in Florida, is because you have to provide a budget. And that budget has to show that the condominium is collecting a specific amount of reserves. And if they are not collecting a specific amount of reserves, then you can't do the loan. And so that's why we do a limited review. A limited review, kind of basic terms, requires a higher down payment. And with that higher down payment, the requirement for a budget is removed entirely. And that's great. Maybe in California, you may not be finding that reserves are a problem. In South Florida, Miami specifically, it's a huge problem. Um, a lot of owners, it's kind of, people talk about it. They say, well, why am I going to put money into an account for someone that's going to use that money 30 years from now? And that's pretty short sighted. I understand what you're saying, but you're leaving somebody else to hold the bag. And I guess if you're planning on being in and out of the thing in a year, then what do you care? But the other owners in the condominium complex um, should still be forcing the funding of these reserves because it's impacting people tremendously because property taxes are increasing, insurance premiums are increasing. Insurance premiums are increasing for the master association. And so now things become more expensive. Now you're putting off repairs and it's a nightmare situation. So, one of the big ones, a lot of the times we get this, it's pretty funny. There's no requirement, whether it's a full review or a limited review, there's no requirement that you have a specific number of people that are owner occupants. The only time that ever becomes an issue is if you're doing an investment property purchase. And the prior restrictions are something that have now been lifted. And so the current rule says, hey, look, if you have, if you're purchasing for an investment property, the investment property concentration limit is 50%, meaning you cannot have more than 50% of non owner occupants in order for Fannie Mae to provide financing on the condominium. That restriction is going away. That's pretty cool. That's a big deal because now it allows more investors to come into buildings and purchase properties regardless of how many other investors are in that community. It's kind of funny, Fannie Mae thinks that just because you're an investor, you're going to cheap out on repairs, and you're not going to want to put money into the association. And it's a little bit backwards thinking, because obviously if you're an investor, you want to preserve your investment and you want the resale value to be there 5, 10 years from now. You want to maximize rents. So if you're not putting money into the complex and you're not putting money back into the property, you're not going to do that. And Fannie Mae has a little bit of an archaic view on investors. So that's a good thing. Now, a note here that it says, which I actually kind of am just now finding out as I'm looking through this. So there is a requirement that on pre-sales, 50% of the total units have to have been conveyed to primary residence or second homes. So on established or existing buildings, if you're an investor and you're purchasing, um, only 50%, I should say, the requirement for a maximum of 50% of investors has been removed. But on something that's new construction, they will require that 50% be owner occupants. And that's a little bit interesting because I'm not really sure why they're doing that, but that's their prerogative. Like I said in the beginning, they are retiring the limited review process. So now basically everything is full review. So one way that we used to get around it is that we would do a first and second mortgage, so piggyback. So we would do a first mortgage that was under the maximum loan to value that would be allowed, so that we could do a limited review and not provide a budget and have the property declined. Um, since they're completely removing the limited review process and now all projects must be full review, that's a little bit more difficult. There is a waiver of project review. So you don't need to get some projects reviewed. And these are, let's see if we could pull this up actually. We'll just go through it. There's not many. So transactions that are eligible for a waiver of project review. So a detached condo. So I have a client right now. He's a developer in Texas. He's building 48 detached condominiums. So there's going to be 3 condominium units per lot, and he's doing a full development. And so those condominiums are not attached to each other like you would think in a traditional building. So, building, whatever, you've got 200 units, they're all attached. Sometimes you have individual structures that resemble like a single family residence. So it's completely separated from any other properties. Those are detached condominiums. They're not common, but they are out there. I've run into some in California. This client is doing a whole development in Texas. And so detached condo unit does not need to go through the review process. So if that detached condominium, like for that particular client, all 3 of those unit owners, if they're not funding any reserves whatsoever, Fannie Mae is okay with that. That's cool. Units in a 2 to 4 unit condo project. So if you have attached units, but it's 2 to 4 units only, um, project review is waived for those. And then this is a funny one. So units in a PUD. So PUD is planned unit development. We would probably think of those more of townhomes, right? Where you actually own the land that the unit sits on. Condominiums, you don't own the land, you just own the airspace inside, and you have a common interest in ownership in the land together with whatever, 200 other people. So you don't technically own the land. But with a PUD, you do. So PUDs, townhomes, they are not subject to review, never have been. And then this says Fannie Mae to Fannie Mae limited cash out refinance. So project reviews waived for units and condo projects for Fannie Mae owned loans that are refinanced as a limited cash out refinance with a maximum LTV of 80%. Oh, that's pretty cool. So I actually didn't even know that. I wonder if this is new. So if you've got a loan that's currently serviced by Fannie Mae and you're just doing a rate and term refinance, you don't need to go through the project eligibility. That's pretty killer, actually. So if you buy a condo and Fannie Mae was okay with the financing 5 years ago, but they quit taking reserves or whatever, um, you don't have to get that project reviewed. That's cool. I'll do a separate video on that. So that's neat. So that's not bad. So you can see there's not really that many units that are eligible for project review. However, there are some. So they're retiring that limited review process. I can tell you that's going to be a big deal here in South Florida because, you know, there are not many condominiums that finance full reserves. And we're going to get into what financing full reserves means in a second, but enhanced reserve study requirements. So, right now, prior to this new rule coming into play, let me see if I can actually blow this up. I'll make it a little bit easier for everybody to read. So right now, the rule says that you have to have finance 10% of the annual assessments. You have to set aside in an account that is specified only for future repairs. So it's a reserve account. That's above and beyond the normal stuff that you have to do. Painting, whatever, stucco repair, things that are normal, kind of everyday maintenance items. This is above and beyond that. The way that you could get around that is if your community within the prior 3 years or 36 months had done a reserve study, and that reserve study would say, hey, you know what? Here are all the components in this condominium complex. These are the remaining, economic life of the components. And, we're guessing that based on inflation and current costs, you're going to need 20 years from now, whatever, $10 million to repair the roof or whatever it would be. Right. And so that reserve study, if you've never seen them, they're really detailed. They're very expensive to get, which is why most condominium complexes don't get them. But if that reserve study in essence came back and said, hey, the community needs to set aside 5% of the annual assessments in a reserve account, then Fannie Mae would look at that and say, okay, you know what? We'll allow you to collect less and we'll still be able to allow you to do a minimum down payment. So it can go full review, even though they're collecting less than 10% in reserves. So what this is saying is it's saying the current policy allows lenders to obtain a reserve study to demonstrate a project has reserves um, when it's not budgeting for replacement reserves that meet selling guide requirements. So that's what I just said. They're updating it to clarify that when lenders do use this flexibility, they have to verify that the budget includes the highest recommended reserve allocation amount. So when you look at a reserve study, it says, hey, if you want to have 100% coverage for the items that are going to need to be done 20 years from now, 10 years from now, etc., you need to collect this month, this much. And then the community can decide they want to collect less, right? They don't have to collect that whole amount. So what they're saying is they're closing the loop there, and they're saying you cannot use less than the maximum amount that they're recommending to collect for the reserve study. So that is kind of a big deal. It's not a huge deal because, quite honestly, not a lot of communities set aside reserves, or I mean, do reserve studies because they're very expensive. Um, Florida just passed a state law a couple of years ago that said that you have to do a structural integrity reserve study, which is like a reserve study light. and those are like $20,000. So these reserve studies are very expensive. So you can imagine if a community doesn't want to set aside money to repair a roof that's going to need to be done, they're certainly not going to be spending $50,000 on a reserve study, which is a shame, but that's the thought process. So this is the big one. So as I was saying, right now, um, they are requiring um, that the reserve allocation for capital expenditures and deferred maintenance is going up from 10% minimum to 15%. So, in simple terms, if the community is collecting $1 million per year in homeowners association dues, they have to be setting aside 15% of that. So they have to set aside $150,000 into a reserve account. So that's a pretty substantial amount. Currently, it's 10%. The good news is that this is not going to go into effect until January 4th, 2027. So, you know, Fannie Mae, for all of its, shortcomings, and, Fannie Mae is fantastic. They free up a lot of liquidity in the secondary market. And because of that, you know, we're able to do loans. People are able to purchase homes at relatively low interest rates and low down payments. So I don't want people to think that, I don't want it to come across like I'm bashing Fannie Mae, because I'm really not bashing Fannie Mae. Um, but it's nice that they're giving communities, basically until the next budget to get the 15% in place. If they just pulled plug and said, hey, this is an immediate change, and everybody had planned on 10% and now they can't fund anything because it's 15%, that wouldn't really be fair to everybody. So thankfully, that's January 4th. The enhanced reserve study that kicks in August 3rd, 2026. And the retirement of the limited review process also retires August 3rd. So lenders can choose to do this now if they want. That's what this guidance letter identifies. They're probably going to give people some time. So, listen, we're in sales, we do mortgage, we're trying to get people to borrow money to buy homes and refinance homes. But sometimes the sense of urgency is actually a real sense of urgency, because there is a real time that's coming that these guidelines are changing and you can't go backwards. And so, if you're looking to purchase in a community that is not funding reserves, and you don't have the down payment and you need to do the limited review process with maybe a first and a second combo, this is your opportunity to do that before August 3rd. Now, do you want to buy in a community that's not funding reserves, that's going to set you up for some special assessments down the line? Um, I would think twice about that, unless they had a reserve study, which most of them don't, as we talked about. So you have to be very careful. I talk to first time home buyers all the time, and, of course, we all want to buy our first home and we want to get into a property, but, uh, you know, unfortunately, most people don't know how to read budgets. Even if they did know how to read a budget, the associations don't necessarily uh, keep good records. The meeting minutes may not cover all of the items that they're looking to replace and repair. If it's just completely mismanaged top to bottom, it doesn't matter if they're going to keep good notes or not. They just haven't had that stuff put together. So it's very difficult for, especially first time home buyers, but really anybody, to front run looking at just a current budget and a balance sheet. So what we recommend that people do is, hey, get the last 12 months of minutes from the HOA board meetings and review those and see what they're doing. You can certainly pick up a tone in the meetings of whether or not owners are engaged, and the mentality of the owners in that community to up for the upkeep of the property. This is a big one that's actually going to help quite a bit, I think. So let's assume that everybody now is getting their reserves in order. one of the major things when we look at these, so agents come to us all the time and say, hey, how much is the down payment requirement going to be? And maybe they may only have a budget. And while the budget may have enough money allocated for reserves for a lower down payment, we always say, hey, do you have a copy of the master hazard insurance policy? And then also, if it's in a flood zone, we need to see the master flood policy as well. And many times, the insurance, because the premiums have skyrocketed from these insurance companies, many times these associations are forced to pare back on coverage or have a co-insurance clause that saddles the homeowners with that homeowner's insurance responsibility for the community. And those are not allowed by Fannie Mae. And so that is another piece of the puzzle that is very, very difficult. Um, so property insurance for 1 to 4 unit properties, I'm not going to go into that because that's not really a huge issue. You're not going to run into that very often. Um, Here's a master property insurance requirement. Let's see what this says. So if you're a loan broker, loan officer, you can find all of the master property insurance requirements um, for developments in Fannie Mae guidelines. It's always there. So you can always find that. If you're a realtor and you don't have a preferred lender that's going to help you out and you're just kind of winging it, and you go to your broker and maybe your broker isn't giving you the support, you can read through these letters, etc., and it'll help you understand exactly what the requirements are. So this is saying the property insurance policy coverage must be at least 100% of the estimated replacement cost value, including common elements. See if this is that's the way it currently is. I want to see if this is saying that here's the difference. Okay. So you need 100% replacement cost. That's fine. A lot of the times the lender is going to require that the insurance company provides a replacement cost coverage letter. And it's illegal for insurance companies to provide a replacement cost calculator in the state of Florida. California, it's different. It's not illegal. So they will oftentimes just provide a copy of the replacement cost estimator used. And as long as that replacement cost estimator, the insurance is at that amount, then the insurance is sufficient for that portion. But anyways, a letter from the insurer saying, yes, it's insured at 100% replacement cost. If it's not identified on the master insurance deck page, that's sufficient as well. So let's see. A statement from the insurer, other professional with appropriate expertise. So you could just get a letter from the insurance agent that says, yes, it's insured to replacement cost. There are some really, really large lenders, very large lenders, maybe even might be the largest lender in the nation, or at least that's what they say. And I have no reason to believe that people who make those claims aren't what they say they are. But they will require a replacement cost calculator, even though it's against the law, and that's insane. So now you can just get a letter from the insurer, so that's great. This is huge, especially here in Florida. The master property insurance policy must provide coverage on a replacement cost basis, with the exception of roofs. So a lot of the times, to save money on an insurance policy, instead of it being a replacement cost value, RCV, it's actual cash value, ACV. The current rules say that you cannot take ACV on roof coverage. It has to be replacement cost coverage. That's really expensive. And so these companies will back out on that just to save money. So it's nice that we can do that now and have actual cash value instead of replacement cost coverage. Deductible requirements. Let's see if there's been any changes to that. We're updating our requirements per unit deductibles. With this lender letter, the maximum allowable per unit deductible for all required property insurance covered by a master policy is $50,000 per unit. When the master property insurance policy has a per unit deductible, the borrower must have a unit owner's property insurance policy in accordance with the requirements determining whether or not the replacement cost coverage is sufficient. That's pretty cool. Right now, it's a 5% deductible on wind, and 10% on some other perils. So what they're saying is they'll allow you to go up to 50,000 per unit. And when it does have a per unit deductible, the borrower can cover the difference with their own policy, is what this looks like. When the master property has a per unit, the borrower must have a unit owner's property insurance policy determining on individual properties. Okay. Let's see what they're saying here. We're placing requirements related to when a borrower is required to obtain an individual insurance policy. Okay. So they have to have a unit owner's property insurance policy when any portion of the interior of the unit to the unit are not covered by the master policy. So that's pretty straightforward. So you have to have a contents policy. Uh, if the master insurance doesn't cover the inside, which I don't know if that just doesn't exist in my career. I've never seen a master policy that covers the contents. So that makes sense. Minimum amount is sufficient to cover any portion of the interior of the unit. That's fine. Coverage amount sufficient should be based on the best information from the carrier. And then they've got the amount of the required perils. And the unit owner's property insurance must provide coverage on a replacement cost basis. That's fine. The updates to required perils and loss settlement are effective immediately. Lenders are encouraged to implement the changes immediately, but have to do so by July 1st. So again, if you're borrowing money, this is not really a big change. This is something that is already required now, so that's fine. Deductible requirements. With this lender letter, the maximum deductible for unit owner's property insurance policy for all required perils is 5%, okay, or 2,500, whatever is greater. No big deal. And then again, these 1 to 4 unit properties, you're not going to run into that very often. I mean, I haven't. I don't even know if I've ever done a 2 to 4 unit condominium. We've done detached condos, but I'm not sure about 1 to 4 unit. So I'm not really going to go over that because that's not anything that's like super pertinent to us. Um, so lender placed insurance or modifying. You never want lender placed insurance. It's going to be way too expensive. I'm not really going to concern myself about that. So it's not all fire and brimstone. This is not emergency status, but it is going to make it more difficult to have lower down payments on properties in some areas. And you'll know your local area, what the custom is. I know in Northern California, we do a lot of loans there. We never really run into any issues with funding of reserves. Really, I think there's just a couple of pockets that have issues with that. So that's not really necessarily a huge killer for most of the country, but it could be for your localized market. And then the other thing is, the investor concentration is going to be reduced. I still really think it's neat that you can have a project review waiver based on a refinance if Fannie Mae already services the loan. And it's under 80% loan to value. So that's really cool. I didn't know that. So that's going to be interesting for people in our industry, in the mortgage industry, to reach out to those people who have already purchased and these rule changes come, they can do that. So that's the long and short of it. Again, there's other options. Non-QM loans right now are really, really pricing out very competitively. You can do DSCR, so debt service coverage ratio loans, so non-owner occupied in, maybe not anymore right now with everything that's going in with Iran and treasury yields increasing, but you can most certainly um, get rates in the low sixes on an investment property, no personal income, only using cash flow from the subject property. It's amazing. And you can even do those non-QM, so non-qualified mortgages on primary residences as well. And those rates are still competitive as well. So, if you don't have the income and you need to do a bank statement income loan, those are very good options for you, of course. Um, P&L loans, 1099 income loans. Now those loans are going to require a greater down payment. So that type of client wouldn't be looking at something that would be, maybe a full review, 3% or 5% down payment loan. So that's a big deal. One of the other things in here that is actually maybe another benefit is the state of Florida had special financing restrictions that required a 5% greater down payment than the rest of the country. And why is that? Well, because we have issues funding reserves here. And so, maybe the rest of the country, a 20% down payment would allow you to get a limited review. Well, in Florida, on a primary residence, you need a 25% down payment in order to get a limited review. Or I should correct that and say, the maximum loan to value for the Fannie Mae loan could not exceed 75% in the state of Florida, whereas the remainder of the country, it was 80%. So those requirements are going away now because there's no more limited reviews. So get your stuff in and closed before August, because if you don't, you're going to run into some issues with getting your financing done if you're going to rely on a limited review. So appreciate everybody for tuning in. Yeah, sorry about the late start and our technical difficulties, but hopefully we'll be able to do this more often. And we're going to be doing some mortgage rate pricing uh, lives where if you have questions about mortgage pricing, we're happy to answer those. I'll price loans right out on the air with you guys. So show you what you're at. If you've got a loan that's not competitive, even if we don't lend in that state, we'll still give you the real deal and give you the truth about what your mortgage rate should be. And we'll show you some competitive pricing and all that cool stuff. Answer guideline questions if you have any. If you're in a pickle, you've got a loan that's going south, whether you're a realtor, another loan broker, a client, I'm always happy to help and answer those questions. I have quite a bit of experience in the mortgage industry, so I'm happy to share that with you. And yeah, thanks for hanging out. And now that I've got my uh, technical difficulties straightened out, we'll be able to get it done on time.